Welcome to the panel. We're very excited, actually. As Maria said, we've got a very interesting range of people here. Hopefully the discussion will be lively and maybe even controversial. I'm hoping it'll be controversial. My name is Dan Keeler. I'm the Frontier Markets editor of the Wall Street Journal. For those of you who are not particularly familiar with the terminology, frontier markets are small emerging markets. So they're all over the world. We've got places like Vietnam, Bangladesh, Argentina, Ecuador, and as it turns out, most of Africa is considered frontier markets. So Africa falls very squarely in the middle of what I cover at the Journal. We're trying to change the narrative about places like Africa, particularly countries that get typecast. Most frontier markets tend to be typecast one way or another. And what I'm trying to do is to inform investors and readers that there's actually a lot going on in many of these countries, and it's not just about Ebola in West Africa. It's not just about factory collapses in Bangladesh. There's a lot of investment opportunities, and there's a lot of activity going on there that people really should hear about. So this panel is going to look at some of the challenges facing private equity firms operating in Africa, and also some of the opportunities and some of the innovative solutions that they're generating. We'll also look at the critical role that private equity can play in helping to foster general economic growth in small emerging markets. And I want to read you something that I have cribbed from a United Nations Commission for Africa report that I feel encapsulates the role that private equity can play, and hopefully the panel will bear that out. This private equity manager described it as allowing small and medium-sized enterprises to grow, to create jobs, and at the same time to contribute economic growth to the country. At the heart of the model is the idea that SMEs are the key engine of African growth, and investors need to provide resources to SMEs so that they can grow, and once they grow, the larger players within the market can pick them up and bring them to the next level. So my belief is that private equity in this context is providing a foundation that can really help economic growth to develop. So before I get started, I want to introduce the panelists. We have, at the far end, we have Ganesh Rangaswamy. He's the managing director at Frontier Investment Groups at Axion. I hope I pronounced that right. Actually, would you mind just saying a couple of words about your firm? So.
Sure. Thanks, Dan. This is on. Thank you, Dan. Good morning, everyone. As Dan said, I'm one of the partners at Frontier Investment Group at Axion. And Axion is an entity that has been operating in financial services in emerging markets for almost 5 decades now. And we primarily focus on offering financial services to improve the economic well-being of what we call the underserved consumer. And pretty much all emerging markets in Africa, Asia, and Latin America are under purview. And as a part of Frontier, as a part of Axion, we at Frontier are the investing arm, and we focus on sort of, I would say, growth stage venture capital primarily, and early stage private equity. So that's the spectrum in which we operate, largely focused on financial services.
Thank you. Next to Ganesh, we have Ambassador John Simon, who is a founding partner of Total Impact Advisors. He's also a former US ambassador to the African Union, and he was an executive vice president at OPIC, which is the Overseas Private Investment Corporation. Perhaps you could say a few words about it.
Sure. I don't know if this is doing me any... Oh, actually, now it sounds like it's helping out. Total Impact Advisors is an advisory and merchant banking firm focused on impact investments. Impact investments are investments that have both a social and a financial rationale. Africa, you find a particularly large pool of investments that can both do a lot of good and also help their investors do well. We work with private equity in 2 ways. One, we help design and raise capital for a number of private equity funds, including the Investment Fund for Health in Africa, which is very similar to one of Abraja's funds, which is not to be confused with the Health in Africa Fund, with the African Invest Financial Sector Fund, and with some new funds that we're bringing to market. And we also work with companies to help them raise capital from private equity funds. So we're one of the few folks, we're the folks at the table who've been on the other side of the table with a lot of the people here, and can describe what that experience feels like.
Thank you very much. next to John, we have Kamal Palan, who is a partner and the COO, Chief Operating Officer of Karamo Capital.
Thank you, Dan. Thank you, panelists. So Karamo, we are an independent investment manager. We focus exclusively on sub-Saharan Africa. We have a multi-asset class mandate, although we focus probably the 60-70% of our investments in private equity. And most of our investors are U.S. endowments and foundations. And we have an office in Lagos and soon an office in Nairobi.
Thank you very much. And finally, we have Alan Fields, who is a managing director at Abraj Group. So,
Thank you, Dan. Good morning, everyone. The Abraj Group is a $8 billion global private equity firm, primarily operating in 25 offices around the world. With respect to Africa, continental Africa, we have managed since our inception over $2.6 billion in 80 transactions in 16 different countries. We basically split Africa, North Africa. We focus on with the MENA region and a dedicated team. Then we also look at sub-Saharan Africa, where we have offices in Kenya, Nigeria, Johannesburg, as well as Ghana. And our focus is primarily on consumer-oriented strategies. So we're in the financial services, we're in fast-moving consumer goods, we're in industrials and manufacturing.
great. Thank you very much. So we're going to start by just talking about the role that private equity is playing in Africa at present. And then as we go through, I want to talk about what it can do in the future and obviously discuss impact, which I think is a very important part of it. But to kick it off, Alan's very kindly volunteered to actually explain the role that private equity is currently playing. So I'm going to hand over to you.
So private equity, obviously, we all know that it's a private investment in a particular company. In Africa, because of its frontier nature, as well as the capital markets, which are in most of the particular countries, are pretty limited. For instance, Nigeria, the public markets, the total capitalization is about $86 billion, which is equivalent to Nike today. And the representation of the public markets do not really reflect that of the underlying economic sectors in the countries. Private equity is basically an area to access a lot of the different industries and family businesses in Africa, particularly those in the consumer-oriented sectors. So our role basically is to provide growth capital to those particular companies to help them expand, but also in addition to growth capital, because Africa is a growth story, right? We've heard it in some of the other panels that was out here, driven by basically the rise in the middle class, the rise in consumer spending, the urbanization, as well as the demographic dividends. And so therefore, what we're looking to do is invest in middle market family businesses and help them grow, and also to provide institutional knowledge, best practices that we've and other private equity firms have learned from the other markets and other regions, so that these companies become sustainable companies for the long term.
Do you want to add something to that?
Yeah, I would just echo what Alan says and add a couple of points. I think the one thing that differentiates private equity in sub-Saharan Africa from maybe private equity in the rest of the other parts of the world is that there's very little use of debt or no debt outside of South Africa. There's no leverage. So all of the private equity, there's no leverage buyouts. So the kinds of things that give private equity a bad name in more developed markets, it's pure growth capital, and as Alan says, it's really getting your hands dirty, fixing things up. And the other thing I would say is that, contrary to the perception that Africa is low-hanging fruit, I don't think there's low-hanging fruit anywhere. So it's not like you're just going to come in and make a buck. It's really about coming in and really adding value and operational excellence into these companies.
And just to add also, private equity relative to the public markets also is much more of a long term. I mean, you're investing basically in a company, so it's much more sustainable, it's much more patient capital. So as a result, you can actually withstand some of the volatilities that are in the market and some of the nuances and headline risk associated with the public markets.
I mean, maybe to inject a little element of controversy, I do think you're right that traditionally private equity in Africa has not, availed itself of the financial engineering that created such large returns in the developed world, and then also created such a cliff with the financial crisis. But I do think that's changing. I mean, for instance, if you look at the keynote speaker this evening, what AFIG does,
Yes.
they do a fair amount of financial structuring, and again, you can argue whether that's good or bad. And Papa, I won't sort of speak for him, but I do think that you're seeing more financial structuring coming into place, and it is an open question whether it's going to add value or potentially just add risk. And the other thing that you're seeing is, a big part of the private equity story in the developed world was multiple expansion. And for a long time in Africa, I think, like you said, you didn't get the benefit of that. That may be changing as well, which again might be good for those of you who have investments today, might be bad down the road.
Can you actually just expand on the multiple expansion
Yeah. So,
question?
If you look at the way that a lot of the big name private equity funds, the Carlyles, the Blackstones, the KKRs, made such great returns from their inceptions in the 80s through sort of the end of the 90s. When they bought into some companies, those companies were valued at, say, 4 or 5 times EBITDA, and then the values went up to 7 or 8. Basically the company didn't change; they just had the benefit of a change in perception. And I think that's good at one level, because obviously it means that maybe perceptions are more reflecting reality. It's bad at another level because it means you're not doing the hard work of trying to improve the company. You're just sort of placing a bet that you can pass on this company at a better price without any real change in the underlying value. And at some level that means that the industry isn't doing what these folks are paid so well to do, which is create value at the enterprise level.
But and that runs the risk of giving private equity a bad name again.
Absolutely.
Right. Ganesh.
Just on a different note, to add to what everyone's saying, I think one of the broader trends, and maybe we'll talk about this later, that we are seeing is more and more institutional capital into Africa, as opposed to, I guess, I wouldn't say historically forever, but for quite some time we have seen sort of single LPs or family offices, or sort of, without making it too controversial, distorted capital on the back of a good story. But I think we are starting to see more thesis-oriented, more disciplined investors, more institutional investors now coming in, which is going to hopefully drive us more towards making this story a reality. And thankfully, we're starting to see more of that in the last few years.
It's that a double-edged sword, though, because when you've got institutional money coming in, institutions have their own needs and their own desires that may not necessarily mesh that closely with the companies they're investing in.
Yep.
So what about the downsides of that?
No, it's an absolutely good point. I guess, just like everything else, there's got to be a balance. For example, given what we do, I think, we try to maintain that balance perfectly because, to John's point, we are an impact-oriented fund in financial services, completely focused on unserved and underserved consumers. So the idea always is, yes, you have to drive financial success and firms' performance, tighten the governance, figure out how we work together to build the right leadership. At the same time, I guess we have to ensure that whether from a product, service, and customer protection point of view, we also deliver. Does that mean it's going to take a longer time frame? Probably. Does that mean we'll see failures? Yes. But we try to maintain that balance. In the process, we also bring in investors who sort of counter sometimes maybe our aggressiveness on profitability. Like we do co-invest with several DFIs. We do co-invest with several funds which have lot longer horizon than us. But there's no perfect answer, but one has to maintain a balance. But net-net, we believe it's better for Africa that we move in that direction than traditionally the good story, let's just go in and make an investment.
I do think it's important that the net positive of institutional money coming in is to lower the cost of capital for businesses in Africa. And a lot of businesses in Africa labor under an extraordinarily high cost of capital, which then impacts their growth potential. And if that alone happens, that's going to increase the value of the businesses that all these folks hold. So that's good. But you do have to be wary of the institutional money pushing too much in one direction, looking for purely a very defined IRR hurdle that may be unachievable in certain situations, and pushing folks to do the types of bad practices that we talked about that gave private equity a bad name.
Right.
I would just add that, I mean, there's certain businesses and certain sectors that in Africa that are growing phenomenally, double digits CAGRs on a year-over-year basis. And you can go in and buy those particular companies or invest in those companies. And usually what happens is, because their growth, their family businesses, you're not actually buying out that company. You're actually going and investing as a minority investor alongside that entrepreneur, that family business. And then what you do is you obviously, they have organic growth. You want to capitalize on that organic growth, but you also want to enhance that particular growth. And that's where you can generate really attractive returns through the value creation process. When you go in, and the key is obviously to align yourself with the right firms and with the right partner. We call them partner companies at a barrage, portfolio companies, because we want to make sure that they're aligned with the value creation agenda that we help to assist with them. And if they are, whether it's expansion, whether it's not, it's rolling out new products, whether it's not changing the product mix or the pricing, we want to make sure that that company is profitable and that EBITDA is growing. You do get some multiple benefits, because what you do is sometimes you go in, you increase the governance, you add more management, you add a board of directors, you institutionalize these companies. And then you also practice ESG, which is very important, and then you get the benefit of a turn or two in your multiples.
So that raises a question for me, which is receptiveness of the companies that you're actually, your target companies effectively. Firstly, are you seeing an increase in the awareness of the benefits of private equity or the receptiveness of companies in African markets? And secondly, are they aware, or do they feel that private equity is an appropriate model, or would they much rather have just pure equity investment? Anyone want to? Ganesh?
Yeah, sure. No, that's a great question. I think we face similar challenges in a number of our markets, given all of them are in different stages of what we'd call frontier or emerging markets. First of all, private equity is not for everyone. Obviously, we kind of know that, but the test is when you really sort of come across the company, and when the company kind of experiences what you have to offer as an investor. And sometimes you have to go through that process of discovery. So I'll just use an example of one of our portfolio companies. It's called Zuna, based in Zambia, South Africa and Zambia. They're now expanding to 5 countries. Basically started by 2 brothers. It's a mobile money platform and electronics payment platform, primarily for small merchants. They realized at some point that the opportunity is much bigger than what they can do themselves. Brought in a professional CEO, brought in private investors, including us, beefed up the board. We have strengthened the governance, built next level leadership. And it's almost like a dream story, because all of these things, each of these things is very difficult to do. I mean, if you just think about it from the point of view of how willing they were to let go. In second year, right now, the company went from $1 million in revenue to about 10 million in run rate in 2 years, which is sort of what we see in Silicon Valley, honestly, not as much in some of these markets, expanding to 5 countries. So, I mean, we are certainly starting to find opportunities of that nature, but it's not for everyone, right?
Yeah.
But yes, it's happening.
Yeah, I would just say that private equity, the classic tension between the owner and the equity investor, it's in all markets, right? I mean, especially as when you're doing growth equity, you're a minority investor. There's a natural tension, and it's a good tension. I think what the recognition is that, how is that helpful, right? And I think maybe a lot of it in Africa, as it in other markets, is generational, right? So you may have the founder, and then his kids come to Wharton or Harvard, and they go back and they're like, hey, wait a minute, I met some really smart people and they have some really good ideas. So I think a lot of it, exactly. So a lot of it is generational, but I would say that in terms of that tension, it's in Africa as it is everywhere else in private equity.
I do think you made the question, is it a question of pure equity versus private equity? I think the question is less a question of pure equity versus private equity than a question of private equity versus something that looks a lot more like debt. And a lot of the owners of companies in Africa, and we go through this education process when they come to us to talk about putting together a financing proposal to the market. In their mind, they're much more comfortable with the idea of something that's a debt-like instrument that they can ultimately buy out the investors or pay it off than giving up a real share of the company. And it's often an education process for people to understand why there's value in that, why not only do you potentially get more money, but you also get a whole lot of other expertise and connections and network that you don't get if you have just a pure debt-like financing.
So one of the things to alleviate some of that, what we call counterparty risk, which is basically investing in a company and then having some problems with management or the shareholders, is to do extensive due diligence. And one of the things that the Barrage tries to do to mitigate that is that we have people on the ground in each particular region that we're looking that are native to that particular country that can source out those opportunities. And we take an extensive amount of time to understand these companies. So before we're talking numbers or talking a particular investment, we have known that company maybe for 2 or 3 years. And we talk to them about the opportunity to partner and how if they have the same objective, again, to become a market leader, to grow, to scale up their business. $1, owning 100% of something worth $1 is not as attractive as owning 50% of something valued at $3. And so that's the value proposition that we bring to them, not only smart capital, but again, operational and strategic capabilities. And so what happens is you get a lot of good case studies. As a result, you show the entrepreneur how it worked in other past cases. Everyone talks, and then you get referrals, and then you can walk to, you can utilize that to talk to other opportunities. So for our particular case in the past, a large percentage of our deals that we worked on were proprietarily sourced. We really refrain from the auction process where we're bidding just on the basis of price. We really want to work with that particular entrepreneur and to help him or her grow their business.
I just wanted to pick on a point that John made, which is, debt. What are the kind of instruments? What are owners comfortable with, or promoters comfortable with? Right? And we have seen this evolution in multiple emerging markets, and even, Africa is first of all 54 countries, and the markets, dynamics are very different from countries in East Africa to West Africa to South Africa. But we've seen the same thing in India and some of our Latin American markets. I think. If you go to Silicon Valley, people understand the value of equity. It's not even a conversation, right? But people conceptually get it in number of the emerging markets you operate in, but you believe it only when you see it. And you don't have enough success examples. So in the absence of that, people like the concept, but you got to show them the value. So I think with successes, this will change. So, but I think the reality is what it is today. So it's improving. But once people start seeing more successes, they'll say, okay, there is a value in bringing equity in, giving someone seat on the table, getting them on the board, and not getting too worried that they're going to control me, but net-net they'll help improve the business. So I guess I would say it's work in progress to different degrees in different markets, but that's what will make the difference. Successes will speak for themselves.
All right. So that's something I want to, that's something I want to pick up on in a minute. I did mean to do this before, actually. I wanted to ask the people in the audience, how many of you are interested in getting involved in private equity in Africa? Is this that's a lot. Okay, good. So what I'd like to, we've already heard one success story from Ganesh. I'd love to hear like a success story from each of you that can perhaps inspire people and show what you can achieve beyond just returns, but on a deeper level.
Well, out of 80 transactions, I have a few. But the one that I like in particular is a company called Brookside Dairy out of Kenya. We invested in this dairy company. It's a company that has a different sort of collection model. Its suppliers is over 150,000 farmers throughout Kenya, some basically with 5 cows or less. So you can imagine, compared to the United States, where there's probably less than 500 dairy farmers supplying all of our milk. And some of the things that occurred with these particular farmers is that during the rainy season, for instance, their production of milk is great, but there's more than we can use. And so as a result, what we've done is develop dry powder capabilities where we can take that excess milk, form to dry powder, and then reconstitute it later on. We also basically started to engage in what we call forward market pricing. We were one of the first firms to do that. So our farmers were then able to see what price they can get based on their production, so they didn't have to speculate, and that assured us an ample supply of milk. The other thing that we tried to do was work with some of the farmers to train them and to provide them, in lieu of cash sometimes, we will give them grain and feed so that they can basically feed their cows and have, again, assure a certain quality of the milk that we're receiving, provided also with agricultural training. This has been a phenomenal success. We just had a large multinational organization that came in to make an investment in Brookside, Danone, better known as Danone in France, to make an investment so that they can then use this distribution network to obviously bring in other products to this marketplace. And we're very proud of our partnership with Brookside Dairy.
So that seems like you've really got deeply involved in that company. You're not just putting money in and letting them get on with it.
Right.
Like you're actually facilitating the growth of their business in a very real way.
Exactly, because again, I mean, one of the keys to success in private equity is first the investment, the entry-level price that you pay for it. But again, some of these companies are growing attractively. But now, some of the keys to really generate attractive returns is the post-investment enhancements that you make. Again, the value creations. What can I do to scale up this particular company? And that's where a unique set of skills come in. So you have people that are able to negotiate transactions, that have sourcing capabilities with the entrepreneurs. But then you also need that operational and strategic capabilities that come in to work alongside what we call the deal makers. And so some of you that are engaging in private equity, that is also another opportunity. If you're coming from backgrounds in particularly in the consumer goods industry, strategic planning, these are skills that are needed right now in the private equity space in Africa.
Yeah, thank you. So I would say one of the areas that we are particularly trying to focus on is technology space. So everyone here knows the amazing technology story in Africa, almost 1 billion cell phones, 100 million lines just in Nigeria. And it's one of the areas that we feel you can make a ton of money, but also there's a tremendous amount of collateral benefits to technology. So one transaction that we think is somewhat unusual for private equity is we have an investment in a startup, actually. It's called Solo Phone. It's a fantastic Nigerian phone company. They do private label. They make the phones in China and then they market them in Nigeria. And it's a $100 smartphone, fully functional with music, preloaded content. And we typically don't do early stage. It was brand new, but we came in early stage. We took a founding seat. And it's an example where there's a fantastic entrepreneur, terrific idea, and the role that we've had is, alongside our other co-investors, is to put some structure around it, put some best practices around it, so we're on the board. We add some capacity around the finance functions. So it's really a lot of things that Alan was talking about, some structure to help these incredible group of entrepreneurs kind of jump down the right direction. So. Whether it makes a ton of money, we hope it will, but it's very early days. But it's something that I think is interesting because it's a startup, and typically people in private equity don't do startups.
Right. Yeah, and that example, all the examples so far bring up this aspect of impact, which I do want to talk about more formally in a moment. But it feels to me that that's underlying everything in a way, is looking at the impact beyond just purely making money. So.
I mean, I don't think so. I mean, we're a purely commercial investor. I worked at IFCs for many years. IFC is a commercial investor. In my opinion, when you do a investment correctly, that creates far more long-term sustainable impact than doing an investment half and half. In my opinion, and I may be wrong, it's you do the investment, you do it right, you put up controls, ESG. And 10 years later, you will have hired many more people. You would have paid much more taxes. So you do it right. Don't worry about the ESG that will come. I mean, I don't mean ignore it, but I mean
we're on the impact side of the table here. So
this is a neat segue into you talking about
a different view, and I'll describe the view and then describe then describe the case, the investment case that we would use that I think shows this view. I don't think it's a question of either or. I think investments in refineries, investments in, trying to think of some of the other things that would fall outside the impact world. Investments in pure manufacturing of widgets, investments in luxury hotels and large-scale commercial banks. These are all positive things. And I don't think as an impact investor that no, people shouldn't do that. But there are other types of investments, investments that have an underlying social impact as well as a potential for financial return, that are not likely to get purely commercial investment, but still have reasonable upside. And by selling both the impact case and I take the example that Ganesh mentioned, I mean, that's a wonderful investment. In 2 years, 1 million, 10 million, but Frontier doesn't invest in that if they don't see it as serving an impact population. And I think there are a number of investments that have an impact case, and that those investments can attract capital that wouldn't necessarily flow to them if it was purely commercial capital, and yet they can help those investments succeed and ultimately be attractive to commercial capital. I mean, an important point in my view about impact investing is it's not a room that you go into that's completely divorced from the commercial investment side. Every impact investment, in my mind, or every one that we take on, should aspire to be a commercial investment. It's just at a stage in its life where it's going to need folks who value both the underlying impact as well as a commercial investment to make it work. And the example that I would give is the investment that launched the Investment Fund for Health in Africa. So the Investment Fund for Health in Africa was started by an NGO that was one of the first ones to do AIDS treatment in Africa. Nothing to do with investment. It was started, the guys who did that were scientists who really created the ARVs that became the basis of the President's Emergency Plan for AIDS relief. And they figured that when they were trying to pilot the AIDS treatments, they looked for folks who could actually pay for the drugs. And there were two folks who could do it: defense departments and multinationals. And so they were working with Shell and Heineken and Unilever and a bunch of multinationals in Nigeria. And they were providing the AIDS treatment through a third-party source. So you didn't want to have the employer know who had AIDS and who didn't. So they would provide it through what was basically a health plan, a HMO, that was called Hygieia. And then along came something I was very involved with, which was the Global Fund and the President's Emergency Plan for AIDS Relief, and they were going to provide AIDS treatments for free. And these companies said, oh, that's fantastic. Thank you very much, NGO, for helping us provide AIDS treatment, and thank you very much, insurance company, HMO. But now we'll go get this from the U.S. and the Global Fund, and too bad, that'll probably put you out of business. And they went to these companies and said, wait a minute, before you do that, let's see if we can provide a way to channel some of that money, not directly to the AIDS treatment, but as a subsidy for the people who have AIDS. It's basically a risk pool. Mm-hmm. And if we provide that risk pool, which is a natural role for government to play, you can continue to provide the health care through the Hygieia. Hygieia can continue to succeed, and we can put investment from you into Hygieia to help it grow. And in fact, they got all those companies to create something called the Social Investment Fund for Africa, which invested in Hygieia. Hygieia was able to continue its role providing health care to these folks. The AIDS drugs were subsidized by these programs, but not directly, but indirectly. And they ultimately wound up raising additional capital for Hygieia, and that became the first investment for the Investment Fund for Health in Africa. Hygieia grew from 50,000 members to now well over 300,000 members. Some of those are subsistence farmers, some of those are middle class folks. It received investment from pure private equity firms like Satya, and now it has a commitment for an exit at, I think, an IRR in the range of the high 20%. Mm-hmm. Yeah. So, I mean, Hygieia is going to go on to become a purely commercial company, but it was an impact rationale that created an impact case that created the rationale for the first investment.
No, okay. Go ahead.
No, please go ahead.
So I
Yeah.
totally agree. But I think the idea is that there's different constituencies for different. So in my opinion, I'll give you a spectacular success story of not even impact investing, just grant giving, right? So if you think about this wonderful story about curtailing Ebola in Nigeria, it was actually on the back of a grant from the Gates Foundation to set up a polio clinic, and then they leveraged that into the Ebola containment center. So there's no Ebola in Nigeria. You could argue that's worth 10% of GDP. So that's what's the return on that? It's a spectacular return, right? But I think there are certain sectors that are more amenable to impact investing. Health, the health, micro lending, places where private equity just can't do a right model. I think what we're saying is in the classic private equity, we're looking at manufacturing or consumer or banking or telecom. There, I think the idea is that you do it right, you do it sustainably, you measure this stuff, like Abraj has your really well-known index, or IFC has the index, and I think in those sectors, if you do it right and you do it well, over the long term, you'll do very well.
The one last point I make before I give it to Ganesh, because he'll probably make the case better, I think the part that you talk about doing right is common across both purely commercial and impact investing. In other words, impact investors should not be trying to do half and half. They should believe that they have done the same due diligence and have structured the same deal that they would have if it was a purely private equity. But they're willing to put the effort into that education or health where other folks won't go. And, on the other side, while they expect a good return, their return expectations might be somewhat different than what a purely private equity investor would be looking for.
So I don't want to make this an impact debate because that can completely take away from the PE discussion, as always happens when we get started on impact in panels. But
I feel like you're telling me off.
No, I'm not. But first of all, I guess there's a way to reconcile everything that we are saying, because there are a lot of impact opportunities which are not necessarily investable. They don't need to be investments, etc. But having said that, I think folks like us, and especially, for example, we are raising a new fund right now at Frontier, which is going to be an independent fund, and it's the first fund. It's still called an impact fund for the. So we are the first impact fund on Credit Suisse private banking platform. Now we actually don't call ourselves. We wouldn't call ourselves typical impact because of the legacy connotations of impact. But I think the relevant point is really what the ambassador is trying to make here, which is we stand for a purpose. So we would only invest in a certain kind of organizations which serve certain kind of target segments and help essentially, if there has to be a way to measure that we are net making a difference to these target segments in tangible ways. Now, aside from that, and that's what we stand for, it works well for us. It's very focused from a thesis and discipline perspective. But aside from that, it has to be 100% an investment driven by financial discipline. And we have to ensure that the investments succeed, because only if these investments succeed, today we are seeing Credit Suisse, and then we'll have JP Morgan, and then we'll have the mainstream markets coming in. And as one of the former CEOs of Axion, who's now a professor at HBS, Michael Chu, always used to say, unless we get mainstream markets interested in this market, this whole impact investing will remain an experiment. But having said all that, a lot of the markets we look at just naturally lend themselves to it, because a lot of basic services are still not as prevalent as you would think in developed markets. So to that extent, they kind of go hand in hand in several times. So you find a great opportunity, it could actually make a significant difference for the target segment, because it's so basic that it can make difference to people's lives. And that's what excites us. So we do get enough opportunities while staying true to what we think we want to achieve. I'm not sure if that's a good answer, but some kind of a convoluted balance.
So Alan, I think did you want to add something?
Yeah, I think if you look at continental Africa or even sub-Saharan Africa, you probably have somewhere around 40% of the population that's classified as middle class, and the rest are in below middle class. They will be ascending. There's an estimate of over 50 million Africans that'll be ascending to the middle class, so by the end of this particular decade. But you still have a large swath of the population that is not properly served. And so impact investing is a very important investment. However, as Kamel mentioned, you may have a different constituent behind that and a different objective. Your objective can't be solely to maximize return on your investment. It has to be something that is slightly lower and slightly longer. And so, for instance, with Abraj, we're working with a number of development financial institutions, DFIs, as well as charitable organizations that are looking in the healthcare space and seeing how we can deliver healthcare services to the lower income strata, but yet still achieve a decent return, but not the kind of returns that you have in typical private equity. Now, that aside, I also want to distinguish that between ESG. ESG is very, very different. ESG is something that is extremely popular because we find that you get good value. Before it was a risk mitigant, environmental, you would get sued. Now we see it as a return enhancement. And the reason because of that is because large multinational corporations that are looking to enter into Africa are looking for those companies that are scaled up, that have proper ESG practices, so they don't basically buy something as a liability down the road, where the workers are very productive, and that you have a good stakeholder engagement with the community, with the employees, your suppliers, as well as your shareholders.
So one final point before we put impact aside. It does seem to me that one of the benefits of impact investing and the fact there are all these funds that are focused on impact is that it attracts a different kind of investor. So it is increasing the overall pool of money available to invest, which seems like a benefit to me. So
Yeah, I mean, I think for impact investing, they have to do the reverse. They've attracted one type of investor. They now have to reach out to the mainstream investors and get mainstream investors into the types of funds that Ganesh is talking about. But I do think why impact investing is part of the overall sort of cosmos of this world is because within Africa, in the types of markets that Alan was describing, there are a lot of sectors, a lot of certain countries where really a purely commercial investor would not tread, but an impact investor can. And they can then blaze the trail that a commercial investor can follow. And so that the addition of that type of money into the mix basically helps everyone because it allows capital to go into opportunities that otherwise would be left on the shelf. And then ultimately folks like Alan and Kamal can come in and take them to the next level.
Yeah, I think absolutely. I'll just add a couple of examples, to again sort of bridge what we are talking about here. I was on the board of a company called SKS Microfinance in India, which went public about a couple of years back, $1 billion IPO. It's a microfinance company, which I used to be part of manage an organization called Unitas in Asia, and we actually put the first grant capital in that company. In fact, more than first grant capital, we actually paid off the credit card debt of the founder to get him from US to India, literally. So the last two investors in that company were Sequoia and a fund called Sandstone Capital, which is kind of a multi-asset manager. And of course, they came in and really helped the company go public. And with all the debates, leaving all the debates on microfinance aside on, are they really doing good to the customer or sort of taking advantage of the customer. Net, the results are there to see. It certainly made a positive effect. So I want to stay away from that debate. I don't want to jump from one debate sort of to another controversial one. But the point is, that was a great example of this continuum, saying it literally started with grant and then evolved, and finally these guys came, and there was a role for everyone at the right stage. Whether, like we said, from a governance, preparing to go public, etc. perspective. And again, other example, that in Axion's early days, this company called Kampa Thomas, which again IFC and Axion invested in. And again, there are all kinds of debates, but net, the point is, yes, there was a continuum, and how you got right kind of investors involved at different stage to eventually help the companies grow and scale. And the beauty of these organizations is that because of their success, we have seen so many more come up. I mean, that impact cannot even be measured, honestly, right? And that's the real impact. We see so many others who have followed on the heels of this, and that's really helped them reach these companies reach such a broader consumer base. So I think that's kind of a way to look at how this can really help actually get a return, but also create a much larger demonstration effect in the market.
Great, thank you. So I hope everyone's very inspired by that. I'm going to bring you down a bit now because we're going to talk about the amount of money that's actually going into private equity. The numbers, from my perspective, it looked like the numbers were really impressive, growing rapidly. But then I saw some figures from the Emerging Market Private Equity Association that said the PE raised, the funds raised for sub-Saharan Africa last year were actually substantially lower than the previous year. And this year they're going to be up, but that's just on the back of 2 significant deals. So can anyone talk about whether there is really a surge in money going into private equity, whether there really is a lot of funding available, or maybe there isn't?
So you should ask the folks writing the biggest checks to talk. We write small checks and try to make big success.
Yeah, and part of the growth is again, the growth in the GDP of these particular countries that have quadrupled over the past decade. So, for instance, Abraj started out with investing in SME companies. We were writing equity checks of probably less than $10 million. Those were considered sometimes middle market companies. But those companies that are starting growing on a CAGR basis, 10, 15, 20%, are now much larger companies. So even though we're still focusing on the same middle market, they're much larger. And so as a result, capital that's being raised right now, I think, is much needed capital. Yes, there will be some competition, particularly at the large cap level, where there'll be auction processes that result in slightly higher prices. But they'll still, in my opinion, will still be a substantial discount to the developed markets as well as to other emerging markets. And then secondly, again, the importance is not only what you pay, but actually what you do after you make that investment, the value creation the enhancement that you make on that particular company. But yes, there has been, your figures, I think right now in 2014, the amount of announced funds that have been closed has already exceeded 2013. I believe 2013 was a blip. Obviously, we had Fed tapering, with some political issues, and it was just, I believe, an anomaly. But the general trend is that private equity in Africa is one of the most sought-out destinations of institutional investors. It was, for the first time, exceeded both Brazil and China as the place to invest their capital. And so we'll welcome that private equity. Hopefully, it doesn't all go in the same space. It would move to SMEs, it'll move to infrastructure, to the healthcare space, as well as the consumer. But I think if you also look at just PE penetration as a percentage of GDP, it's still less than 1/10 of what is being invested in the United States. So yes, from an absolute perspective, the dollars are great, but on a percentage basis, we still haven't significantly penetrated the GDP in the countries of these particular countries.
Yeah.
Thanks so much for bringing everybody down. That's
Yeah. I think that it's, in our perspective, there's just far too little private equity money going into Africa. 2 billion, 3 billion, it's really not much at all, right? Considering the 2 billion is the size of a single large cap fund in the US. It's minuscule the amount of money going. But I think the challenge is the perception between, the gap in the perception between the amount of money going in and the reality. So when we go talk to a lot of the investors in the US, all of our investors are US endowments, foundations, private investors. Their first thing is, my God, there's so much money sloshing around Africa. And that's the word they use, sloshing around Africa.
I've used that word
too. So much
actually.
money sloshing around. You're like, what are you talking about sloshing around? There's maybe, a fund of 400, 500. It's very lumpy. You have 2-3 funds raising $1 billion. That's it, right? But what's happening is everyone's out there announcing these deals. People are saying, well, I'm going to raise $1 billion. Great. I'm going to raise $500 billion. And that gets picked up by the press. And all of a sudden, we did some work. Last year in 2013, there was about $11 billion of announced GPs saying, hey, we're raising a fund. Great, God bless. The amount of money that was raised was maybe 2.5, 3 million, right? And that doesn't come back to the market to say, well, you said you'd raise 500, you didn't raise a penny. What happened, right? So investors are seeing these stories about all this money sloshing around, and the reality is there's actually not much at all. We would say that private equity is captured in the FDI, but I would say you could easily absorb 2-3 times the amount of money that's going in today.
But so what's happening? Why aren't they raising the money that they expect to raise?
Look, at the end of the day, I think it is starting. So when you look at the allocations of most U.S. endowments and foundations, that you'd be lucky if they've invested 10 billion endowment may invest 20 million in Africa. So 0.2%. I think it's changing. So the surveys are great that everyone wants to go in Africa, but I think there's a difference between, there's a famous saying, your notebook and your checkbook. I think the checkbook is still, probably 18 to 24 months away. It's just a process.
And I also think this is not Africa specific. Raising funds are often, people's ambitions often don't get realized. And I think that's particularly complicated by the financial crisis. So a lot of those numbers that are lumpy are a function of the fact that, there was a big pullback from the financial crisis, and now that's beginning to be unwound. But I mean, if you think about it, ECP, when it was EMP, raised its first several $100 million fund, I guess about 10 years ago. And I mean, that was just the beginning of people looking at raising that size funds in Africa. Then you had a big ramp up of expectations that people could do it again and again, and that ran headlong into the financial crisis. So I think, you had a whole bunch of people who wanted to repeat that, and that adds up to your 11 billion. But, the reality of making that happen is a function of a very difficult fundraising environment overall.
Yeah, no, I absolutely agree with that. I just want to add one more point that when something becomes flavor of the season, obviously there are a lot of people coming up with thesis to raise money, right? And on macro factors and looking top down, great growth story, emerging consumers, GDP growing, etc., etc. I mean, the reality is we are talking about so many different countries. They all have their cultural, economic, political, and historic past. Right, so they are complex in their own ways. It's not one macro or a set of macro dynamics which can drive to raising a fund. So even though funds get announced, I think the reality, sort of when the rubber hits the road, I think you figure out the reality. Everyone cannot raise money unless you have a solid thesis, or you have a deep enough thesis, and you have experience in doing this before. So yeah, the promise versus reality always lags.
As I think about it, I could actually put some pretty hard numbers to this. So we made a big push on Africa at the Overseas Private Investment Corporation when I was there. And as of 2008, we had made 16 commitments to 16 funds. And each commitment was about 100 to 150 million, and that was supposed to be a third of the fund. So you add that up, 16 funds committed, each one of those about supposedly 200. That's $3 to $4 billion right there, just kind of out of OPIC. Now, that was 2008. 2009 came along. I think of those 16 funds, maybe 4 or 5 got raised. So that's the type of batting average you have in this environment.
But so, sorry, you want to add?
So the question is, from an asset allocation standpoint, an institutional investor, particularly in the U.S., is saying, where do I go with my money? The U.S. equity market is full value. Interest rates at all-time low. Europe is basically flatlined. I've already had exposure to Asia. I've done that story. Where is the next great opportunity? And so what you have is basically institutional investors looking at Africa. However, they're doing their due diligence. They need to understand the story. They need to see examples. I'm full disclosure, a lot of private equity firms haven't exhibited the kind of returns through their exits yet. And so that's been one question, just basically to prove out the private equity model that you can generate attractive returns. However, what's taking place, though, is with new capital coming in, you're seeing not only transactions where normally it is still fairly high in terms of exits to strategic investors, but you're now seeing also exits basically going to another private equity firm. We just had an announced deal, Lipstar, which is a private label manufacturer out of South Africa, where the investors, part of the investors, was a competitor private equity firm. But we believe there's continued growth. So what's happening is you're seeing everyone playing a segment and taking a company through parts of its life cycle and helping them grow because they believe they can add value at that stage of a particular company. So again, in the U.S., I mean, you get headlines all the time. We see all the headlines in the lack of, and the ignorance sometimes associated with Africa. And so our job is basically to educate them on the opportunities, the macro story, and then the key is who do I partner with? After I decide that I don't want to take advantage of the public markets in Africa because the thinness and the lack of depth and representation in the public markets, if I want to go the private equity route, who is the partner? Who has the competitive advantages? And we believe those firms that have local expertise for sourcing, monitoring, and exit, as well as best practices in terms of their overall governance, are those firms that are going to be the most successful.
But it seems that the shallowness of the public markets is really hindering private equity in a sense, that you can't exit into the public markets in the way that you can in the West or in Asia even. I mean, is that true?
I mean, I guess the way that I would look at it is that's one of the risk factors you look at and say, this makes it a little more challenging. Against that, you have to have all the things that Alan was mentioning about a market with double-digit growth, about the the opportunities to serve whole consumer classes that have been underserved, about the poor returns that you can find elsewhere. And I think when you net that out, it's still a relatively attractive proposition. I think from the fund point of view, the shallowness of public equity markets is actually a double-edged sword. On the one hand, it means that when you make an investment, you have limited exits, but of course you can go to the AIM, and you can go to South Africa, and you can list outside of Africa, and now you can list in Kenya and do pretty well. But the other point is there are a lot of deals that in the developed world will go to public equity markets that you can get at a very nice price in the private equity market, because that's an alternative. So from the point of view of the fund, I think it's very much a double-edged thing. From the point of view of the investor in the fund, yeah, it's not the greatest, but there are other countervailing factors.
Yeah, I agree. I think one of the things that Alan was saying, the track record of private equity is people want to get a sense of the exits. So right now, maybe 10% of the exits over the last many years, and maybe 3, 4, 5 exits have been IPOs. But there are a number of markets that if you look at the Nigeria SEC, they're really pushing a lot of the largest private companies. So there's all the towers companies are private, the telco companies are private. So there's a lot of effort to push those companies to list, and those could be multi-billion-dollar cap companies. So I think it probably creates a better ecosystem for everyone once those markets are more developed.
Okay. Did you have another point you wanted?
I was just looking at the time to see, do we have time to?
Yeah, I actually I was thinking about asking questions from the audience at this stage. I've got about 25 more questions that I was hoping to ask, but I feel like I could share the floor. So let's see if anyone, this gentleman here.
What sectors and geographies are you most excited about and looking at right now?
So again, it's playing off a thematic approach where basically you have the young, urbanized, middle-class consumer. So think about that consumer that's young, lives in a city. They're going to go out and shop at retails. They're going to basically go to restaurants. They're going to buy consumer goods. They're going to need financial services. They're going to need healthcare as basically they engage in family formations. So the sectors that are growing the fastest is basically those consumer-oriented sectors that we particularly like, because in most of the countries, particularly the fast-growing countries, most of the GDP growth is not from resources, and obviously the resource prices have helped those countries. It's basically domestic consumption. Over 60 to 70% of the growth of those companies is domestic consumption. Kenya, I think, is 80%. And so clearly, whatever sectors, whether it's utilities, again, financial services, and financial services can range from insurance, microfinance, banking. Those are the industries that are growing the fastest. In Kenya, for instance, motorcycle sales are growing at 20+%. Automobile sales in Nigeria is growing at over 30%. And we just, we're astounded by that. Whether it's sustainable, we don't know, but we like those particular trends.
Yeah, we focus primarily on financial services and financial innovations, and wherever there are pockets to deliver basic or advanced financial services to the underserved consumers. So from that perspective, the markets which have been attractive for us, where we are seeing innovation and sort of adoption of next level financial services, and also growth in SMEs, actually picking on some of the electronic finance solutions, have been South Africa, Kenya, Tanzania, and we also operate in Nigeria. So those have been more attractive and interesting markets for us.
Anyone else on that point?
No. I mean, for us, we focus on the high impact sectors, which are health, education, and agriculture.
All right, so let's see other questions. Gentleman at the back.
Yes, sir. Oh, is that for me?
Yes.
Now it is.
Okay. Is there an opportunity for PE to go into other countries except the major ones that, it seems Kenya, Nigeria, South Africa, you hear these countries all the time attracting a lot of private equity. How about other parts of the continent that aren't attracting this? Are there opportunities there?
Yeah, I think that's a good question. Who wants to take that?
I mean,
Kamal?
I can take that. It actually segues with one of the earlier questions around one of the key markets that we're very interested in. So clearly, you have the largest, and the most well-known, as you mentioned, Nigeria, Ghana, Kenya, etc. One of the markets that we're really excited about is Ethiopia. There's no public market. It's a really nascent. The much of the banking and the telecom industry, all of the banking is closely held by the government. But it's a country of 90 million people. It's just astonishingly huge and at the low level of development. So we're actually we're a small investor in one of the first, probably the only private equity fund in Ethiopia. So it's going to be a real case example of how, all the things around the first fund, the receptivity of that country to private equity, how they work with the market, etc. But we hope that will work.
But so, I mean, Ethiopia is obviously a big country with a lot of large population, so that is, in a sense, a fairly easy transition from a Kenya or one of those other countries. What about places like Burundi or Togo or Gabon? I mean, are they viable for private equity investment?
So Rwanda certainly received a fair bit of investment, not large numbers, relatively small in the grand scheme of things, but certainly a number of deals. There's been a little bit of investment in, for instance, Liberia, post-conflict. There's a fund that was focused almost entirely on Liberia, and another fund that was focused on the sort of 3 countries that now are in the grips of Ebola, but it was the Mano Cap that was focused on all the countries along the Mano River. And I do think, I'm sort of running through my head of sort of deals that are really big, but I mean, a Zambia deal. I mean, Zambia is a 7 million people. It's not a massive country. It's, smaller than many metropolitan areas, and yet this is an exciting deal. So and Zambia has certainly received a number of other PE investments in the ag sector, for instance. So I don't think private equity. I mean, a lot of private equity has gone into Nigeria, a lot into South Africa, a lot into Kenya. That shouldn't be surprising, but certainly not excluded the smaller markets.
So the answer is basically yes.
Yeah, I guess I would just say yes and no in terms of those. So, for example, in Kenya, right? So if you want to access the market in Tanzania or Uganda, you don't necessarily need a fund based in Tanzania, Uganda, right? They have the economic community. They're trying to increase the transportation links, the economic links. So, a lot of the private equity funds that we're seeing are saying, well, we'll just base in Nairobi, and then we'll just invest in Tanzania or invest in Ghana, in Uganda. And what that does is it takes a market that may be 10 million and really broadens up to the entire 3-4 country market.
Mm-hmm. I kind of want to take that question actually. So I did actually point to 3 people at once at the back there. So you're at the very, very back.
Hi. We all know a key role that the government plays in private equity investments, and obviously one of the challenging issues, among others, are some of the instability that African governments face and the policies they actually implement in Africa that sort of stunts, or if not stymies, the deal flow into these markets. My question to you is, what can you see private equity funds, asset managers doing to sort of work around this, if not work with the governments, and how are asset managers interacting with the governments in order to ease this sort of challenge that we're seeing?
I feel like that's going to be a country-by-country question, but...
Well, there's a story I have that might shed some light on this. So, the Overseas Private Investment Corporation is a government agency. It's a fully owned, it's a development finance institution fully owned by the U.S. government. So a lot of what we do there is we help promote developmental investments, but we do it within a political context. And during the Nigerian election in 2000, and I want to say 6, I may have to be off by a year, we were getting a lot of information that there was going to be significant violence associated with that election, and potentially a lot of instability following. And there was a fair bit, as it turned out. Not as bad as Kenya a year later, but a fair bit. And at that time, we had a number of the investments we had made in private equity funds were very, very heavy in Nigeria. And so we asked all those fund managers to come in, and we said, we're concerned. You have big investments in Nigeria, and we're concerned that there's going to be instability, and what are you doing to manage it? And they said, and this I think turned out to be true, is look, it'll be a really bad thing if there's political upheaval, but we think the private economy in Nigeria is sufficiently removed from the politics of that country. And I think that's a gross overstatement what it was, but I think in general it's true, that we think regardless of what happens to that election, our investments will do okay. And they were right. And those investments by and large did okay. And again, I think if you look at the situation in Kenya following the real disaster they had in 2007, a little bit later, Safaricom had its IPO and did just fine. I think that's a function of the development of Africa, is you're now seeing a private economy that is not completely dependent on the political winds that happen within the capitals. And obviously, you can take it to extreme and show that that's not true, but I think in the range of what happens in Africa, that political instability, Africa's private economy is developing resilience to political shocks.
Did you want to add something to that, Alan?
Yeah, I think there's been empirical evidence that's shown that those countries that we consider reformers in Africa has significantly outperformed those that have yet to reform. And when I'm talking about reform, I'm talking about opening up, becoming more business friendly, becoming more transparent, add governance to their structures, to also have rule of law that protects against property rights. Those are the things, because governments really benefit. Their objective is to create jobs, spur economic growth, and also move the economy, particularly from informal to more of a formal economy, where they can really identify. Nigeria just had a rebasing of their economy, and they're seeing basically their growth and their projected growth will lead them to one of the world, at the chair of the world leaders in terms of their growth and their size. And so I think there's a lot of evidence that these governments can see from other countries in Africa from the success that they've had.
All right. Sorry, this lady at the front.
Some questions for Alvin. In the beginning, you talked about investing in family-owned businesses.
Yes.
And I wanted to get a sense from you as an investor, like what is attractive about those types of businesses? Because you seem to speak about them a lot from the content that were in your portfolio.
Sure. So when you look at private equity, particularly in the middle market space, whether it's in the supply chains of any particular industry or the distributions, most of those companies are owned by family businesses. And they are extremely aligned. They're dedicated to the growth. They have value systems, particularly for their employees, which is some of the characteristics that we want. And so now it's just a matter of basically saying whether or not we can come to the meeting of the minds in terms of what's the future of this particular company. Where do you want to, how do you want to take it? Whether it's to become a national leader as well as an international leader in the continent. And so, yes, most of our sourcing comes from family businesses and a lot of success stories.
So I'm sorry to say we've actually reached the end of our time, but you can mob these guys down the front as much as you want. I've chained them to their chairs so they can't get away. But I just want to thank the panelists. I want to thank you guys for listening. It's been a really interesting panel for me. So.